Jake, are you back in the USSA?
I'll be back in the USA tomorrow.
All right. That's a Beatles reference.
Can you guys hear this?
No.
Okay, hold on. Oh, that's probably why. Okay, can you guys see it?
Now we can.
Yes.
Okay.
I would say that the biggest thing to overcome is probably not too different for anyone else. Is it sounds like a great alternative.
What was the hardest thing to overcome? Because being in the multifamily industry for a while and maybe doing 1031s, or maybe you hadn't done any 1031s in regards to your syndications, what was the hardest thing to overcome for the Deferred Sales Trust? Because I know for me at Marcus Millichap, this was like 11 years ago when I first heard about it. I'm like, I was selling multifamily deals, doing 1031s to clients, and we're like, "What? This seems like too good to be true." Or how is it really going to be work for me? What was the biggest challenge for you to overcome, David? And then what is it like now that the trust has been closed, and how's it working out?
Yeah, so I would say that the biggest thing to overcome is probably not too different for anyone else. Is it sounds like a great alternative, but what's the catch, right? And I would say, the catch really is, number one, really understanding how it works and getting comfortable with it. Number two, I would say that the paperwork was pretty easy. We thought, you surrounded yourself with a good group of advisors, Robert Kelly, as well as Todd Campbell on the legal side. And so a good team that will take the time to sit down and have a phone call. In Robert's case, we met him for lunch, but a good team that really knows what they're doing. And so that's really helpful. I would say on what would be something that would be, and don't want to say it's a negative, it's just a learning curve, right? And that is taking that money and reinvesting it in deals, our own deals, right? It's a little extra paperwork, yes. However, it's worth it because you can take that money, delay avoiding taxes, and really be able to use that money tax-free, obviously, until there's some sort of a liquidation event, but grow that money, prior to paying taxes, just like kind of a self-directed IRA, right? It's really nice to be able to do that, and it provides us the ability to grow our business.
Yeah, absolutely, 100%, right? And that's what we pride ourselves on, giving you some more access to capital, deferring the tax, right? Versus the 1031 exchange, which can be very kind of challenging. In 99% of the syndicators we work with do not 1031. They don't allow 1031 money in, nor do they do it out because it's just too complicated. But the Deferred Sales Trust is very, very flexible, and it allows each individual to kind of go their separate ways, and then to have their own Deferred Sales Trust to go back into more deals. And you can learn more about that at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. All right, everybody. Hey, welcome to the Mastermind. I'm excited for everyone to be here. We're on our 11th or maybe 12th now. I'm with my co-host. I'm Brett Swarts, by the way, for those who are meeting me for the first time, founder of Capital Gains Tax Solutions and a Deferred Sales Trustee, a multifamily broker. And I'm with my co-host, Jake Miller, financial advisor extraordinaire, trainer of CPAs, a mind that I really appreciate because his mind complements mine well. So, Jake, how you doing today?
Doing wonderful, having a great day, and happy to have the audience we have with us today.
Absolutely. Yeah. Welcome, Clint. Welcome, Mike, Pierce, Catherine, and Warren. And we are going to have a really exciting mastermind today, in that we're going to be doing a live case study of a JV partnership with Warren and Catherine, by the way, here. But before we get there, I want to start with the vision of what we're here for and what we're trying to accomplish, what we're going to be covering. And so we always have our vision, our case study, deal close story of the week. And then we do open up for questions and or do like a hands-on training, which is kind of what we're going to do today. So Jake, you want to give kind of the vision for the Deferred Sales Trust and what folks who are maybe watching this for the first time can expect?
Absolutely. So all those individuals out there who have highly appreciated capital assets, and that could be your home, that could be investment properties, that could be cryptocurrency, that could be money in the stock market. could be assets held by a business, or it could be your business itself. All of those items, when you're selling them, you face a large capital gains. Typically, we help people understand what their options really are with the Deferred Sales Trust, how they can actually take the proceeds of that transaction and roll it over into other investments and continue to reinvest and grow and snowball their asset with more money, because they're not having to chip away at it all the time by paying taxes in the interim. And so that essentially is what we help people do.
Fantastic. And also we have Pierce, who's one of our strategic alliances. He is down in the Southern California area. He's a luxury realtor, and he's also a part of Capital Gains Tax Solutions. He's at one point we've been threatening it. He's gonna be taking over some of the podcasts as the duties for Capital Gains Tax Solutions are growing. So, but he's got to get a good quality Ethernet connection. So Pierce, the question of the week for you is, when are you going to get that strong Ethernet connection?
You know what? I'm actually going to a group of investors' office right now to see if I can't make that work.
Perfect.
I'm on my way. I'm trying to figure it out. It's been a nightmare.
You would have thought he's in the middle of Montana or Wyoming with, like, tough spots to get to the city. He's in Fullerton, he's in Irvine, he's in Newport Beach area. But that being said, Pierce, thanks for being here. All right, so let's move into the deal close story of the week. And let's chat all about the video you saw in the very beginning. That was David Sloan. He's a client of mine. See, David, he is like a lot of commercial real estate syndicators before they meet us. I like to say they're a part of the Blockbuster transaction exit plan, right? Where they are so used to just doing the 1031 exchange. It's all they've ever really known. And David and his partner Jordan, who are both clients of mine, they own thousands of multifamily units, and they learned about the Deferred Sales Trust for the first time about 2 years ago. And very skeptical, very smart guys. In fact, David's an attorney himself, and they have a lot of limited partners that join them. They put the syndications together. They own properties in California and Arizona and Washington and they Texas, and they keep buying more and more properties. So we went through about a 3-month due diligence on the Deferred Sales Trust, having their CPAs look at it, going through every kind of possible scenario for them. And they decided to use the Deferred Sales Trust for the first time on the sale of a $20 million apartment complex in Las Vegas. And for them, what they were doing beforehand was they were either trying to 1031 exchanging, not having a good outcome for that, or they were just paying the tax. And so it was a pretty simple mathematical equation. Their biggest thing they had to get over was, is it legal? Can we trust the trustee? Can we trust the banks? Can we trust all where the money's flowing? And then second, which was, can we go ahead and invest in other apartment complexes that we like to buy? Because we're not in the business of just selling and having all the funds sit either liquid in stocks and bonds and mutual funds we're not as comfortable with, and or not being able to redeploy our capital is just where we really love to make our money. So they sold their first asset in Las Vegas, and they moved their GP interest into the Deferred Sales Trust. Their other LPs were able to just pay their tax. Part of why the LPs paid their tax is because their deals were smaller than the minimum deal size, which is $1 million net proceeds, $1 million gain. But unlike a 1031 exchange, the whole entity didn't have to move. Okay, this is part of what the Deferred Sales Trust is like Netflix versus Blockbuster, right? Because we don't have to have all the partners all agree. And so they were able to exit very seamlessly into their own individual Deferred Sales Trust. So that was step number one. Step number two is they were able to redeploy up to 80% of those funds into a brand new investment property, which they bought in Dallas, and they currently own right now in partnership with the trust. Now, the next step was they actually sold another asset, $16 million deal in Phoenix, and they rolled those proceeds as well into the Deferred Sales Trust. They have gone on to do, they're doing a third one, and that's actually closing in about 2 weeks. And I believe that's a $15 million deal. So the point of all of that is you can go back and watch the full episode of David's entire story from start to finish of the Deferred Sales Trust, but it's become transformational for him and his family because they're saving somewhere between 30 and 50% in capital gains tax and depreciation recapture on every single deal, right? And now they live in California as well. In fact, they're kind of in your area, Pierce. They're in Southern California. I met them down in, what's that place called? Something Kitchen there in in Dana Point, Newport Beach area, Irvine, something kitchen. It's a really nice restaurant. Anyways, maybe I'll come back with that next week. So that being said, Jake, any you want to pull out any nuggets there? Anything that you connect with there?
It was interesting that it wasn't just a one-time transaction. And that is a question that we get every single client. I want to tell you that a lot of serial entrepreneurs that we're working with right now, the reason that they're so interested in this flexible financial tool called the Deferred Sales Trust is that it's not a one-time and done thing. It's something that can be used and can be coordinated with and can be something that helps their entire estate, their kids, their legacy, people that they care about. It's a multifaceted, multifunction thing. And that's something that helps address a lot of issues that people have, because it's rare that people only ever have one financial issue that they're concerned about. And so I just want to say that it's like a glove that just really fits really well, typically when things work out.
Great point. Also, I want to also add they're delaying the income from the trust. So they're delaying it for a couple years. So they're already very high income earners living in California, making a very high income. And so on the Deferred Sales Trust, they're delaying the income from the trust. So not only does it defer the capital gains tax, but it's delaying the income tax, which in California, again, is very, very crucial because it's a high tax state. So excellent. Any other questions from anybody on that deal, or anything you want to pull in a little bit more? And that could be Clint, that could be Mike, Pierce, Catherine, Warren. Any other questions from anyone on that particular deal? Sweet. Awesome.
I would ask Brett, in the conversations that you're having with them, I mean, what does the future look like? What are the future projects?
Yeah. So for them, it's buying more multifamily when it makes sense. I mean, the other thing that's happening right now is they're having harder times finding deals. And again, the Deferred Sales Trust is beautiful because there's no 45-day window to identify, no 180 days to close. And so they're kind of pulling in their money and they're looking for value add properties outside of California. In fact, again, Texas is a big part. They look at Arizona, places that are very pro-business, pro-landlord, rents are growing, businesses are moving there. So that's exactly their strategy. They also did another couple other side deals with some other partners and some other, like one's like a business venture that from a friend of his who's an expert in that area. And so he did just a small amount. So he's diversifying a little bit. And then again, some of it's in stocks, bonds, and mutual funds. We have that 20% minimum requirement to see liquid investments. And so part of it's diversification, part of it's continue to do what they want to do, but doing it when it makes sense for them.
Very
Awesome.
good.
All right, great. So now let's move to the next part of the mastermind, which is the cryptocurrency market. And then we're going to do a live case study as well here with Warren and Catherine in just a minute. And so the cryptocurrency world, we're now up to 3 deals that have closed. In fact, Jake and I just closed this last one. It was a $5 million sale. If you haven't seen that full episode, you can go back a couple one. But that particular client, she worked for Google. She's now retired from her W-2 job. She bought cryptocurrency for around $30,000. And let me back up. She didn't buy cryptocurrency. She bought Bitcoin. Okay. In fact, she's only bought Bitcoin. That's the only thing she owns. Okay. She's a believer in Bitcoin, and it went to $50 million. Okay. But her biggest thing was she was looking for a way to defer the capital gains tax, not just to defer the tax. She also lives in California, to retire from the W-2 tech job, but to fund a new business startup with her college roommate. Okay, so she had an outcome in mind. So we were able to sell at 54,000 was where Bitcoin was. Bitcoin jumped up to 66. It's now hovering around like 61, 62. And so she sold the first 5 million. And January 1st, the plan is to sell 1.3 million to fully fund her business venture. And so that one closed. If you haven't seen that full episode, you should go back and rewind. But that is part of why we're here right now. It's part of why it's cryptocurrency mastermind, not just DST, because we believe you have an opportunity if you're listening to this to not only sell and defer, but to fund your business venture, to buy investment real estate, to diversify in liquid investment securities, to take some chips off the table and maybe even repurchase crypto at a lower price, all tax deferred. And I'm about to explain how this works right now with Warren and Catherine. So I want to welcome to, for the first time, to the Mastermind, Warren and Catherine. How are you doing today? And you might want to unmute yourself so we can hear you. And
we're good. We don't have a good volume control or microphone, but
you sound good.
all good.
Hello. You sound good so far. Yeah, so far so good. And Warren and Catherine, for those getting to know you for the first time, would you give just a little bit about your story, maybe like a 2-minute version?
We don't have a story.
Oh yeah.
I'm an engineer. He's a nurse. We both retired. We both bought property throughout our lives, and then combined our properties, and we have a big Placerville property that we're in the process of trying to sell. What I miss? That's our life in a nutshell. We have 9-year-olds downstairs. Sorry if there's going to be noise.
The twins, right? The twins.
Yeah.
Mm-hmm. And you live in high state California, right? And he had sold, I think it was a duplex or a fourplex in Manhattan Beach, and then did a 1031 exchange into an apartment complex, 15 units in Placerville, which I actually have the pleasure of being able to list, and we are under contract right now to try to sell. So you want to talk about a little bit of that experience of being able to sell high in Manhattan, moving into, I think you bought it for about 1.2, if I recall, 1.2 in Placerville, and now potentially selling it for 2.6.
Right. So bought property in Manhattan Beach, a small half-lot duplex, a block up from the ocean, in 1995 for $250,000. Then in 2009, we sold it for 1.4 to the marketing director actually of Facebook, who lived next door to us. And then we took half of it and put it into a 1031 exchange, bought something up in Placerville, a 15-unit complex, an acre and a half. And now, 10 years later, almost 10 years later, we're talking about selling it for 2.6.
Excellent. And what's the reason why you're considering the Deferred Sales Trust for the first time versus just the 1031 exchange?
It's my wife's idea.
When I say something, that's it, right? As you all say.
I think we're trying to focus on our retirement and our kids. And with being out of town owners and an older property, we're trying to get into something that might be a little more flexible and a little less time.
Fantastic. And as far as like, if you had a vision for where and how the wealth could be invested, and this is part of what we're going to dive into on this kind of this classroom setting here, and with some screen shares and Excel file and breaking down opportunities to buy. Where do you feel what do you most like, know, and trust, and where would the funds be invested?
Well, we're hoping to go back into real estate, but maybe possibly out of California. Not that we don't like the appreciation factor of it. It's just the tenant. I mean, the laws aren't as favorable, or I'm not sure the right term to use.
So real estate, but not in California.
Perfect. Which leads into us right into our what we're going to be covering right now. And so I'm going to share my screen, and we're gonna go fast. But the cool thing is that this thing is recorded, and so you can go back and you can rewind this. Okay, so I'm going to share my screen here. So this is the property that's for sale right now, by the way. And if you're looking to potentially buy a property in the Sacramento area, it is currently under contract, but we're going to try to make a deal here shortly with the buyer. He may or may not perform. And so it's 15 units. It's a beautiful property. It's on 1.5 acres. It's mostly 2 bedrooms. In fact, it's like 90% 2 bedrooms, and there's a 1 bedroom and a studio. It's selling at potentially a record price, by the way. Record price of about $2.6 million. About a 4.93 cap rate. Okay, so it It has a lot of unique features, but the key here is for Warren and Catherine, they bought it and it's about doubled in price, right, or more. And they're looking at a very large gain. And so in California, federal capital gains tax, state, Obamacare, and depreciation recapture, somewhere like 40%. Now, they've also depreciated this very low, okay? So their depreciation, since they bought in Manhattan Beach, and I don't know what the latest adjusted basis numbers were, but I think we're pretty close to zero, right, Catherine and Warren, or a couple 100,000 maybe. So we're just gonna assume zero, okay, just to keep it simple. 2.6 million at 40%. That's $1 million. That's $1,040,000, right? Which is pretty incredible. So they could sell, pay $1,040,000 in tax, right? Or they could sell and do a 1031 exchange, but the challenge again with that could be a number of facets. And we've talked about that previously, but we're going to focus on now sell, use the Deferred Sales Trust, but also buy investment real estate, okay? So one of the goals is to purchase investment real estate. So this is our case study we're looking for. And Warren, do you want to tell us where you were able to check this deal out? I think you flew out to Texas and you spent some time looking at this. You want to briefly just touch on that?
Yeah, it's just a new construction duplex out in Texas, and because it's new and because it's in Texas and because the numbers seem to be favorable, I just went ahead and purchased this one little duplex just to kind of test the waters.
Yep. So you've already bought one. You flew out there. Is it near Lubbock? Where's it located again? Or
Correct. That's correct.
It's in Lubbock, right? And so the question was, hey, Brett, Warren and I, Catherine and I just bought this property. Could we also buy more of these with the trust? And the answer is absolutely. In fact, up to 80% of the funds the next day could go towards down payments or buying it all cash for this duplex. And so, Warren and Catherine, what are the main questions you have here? Be thinking about those. But what I'm going to do is I'm going to walk through how this works, okay? Because this is without this concept right here I'm about to teach you, the Deferred Sales Trust to me is a 2 out of 3 out of 10, okay? 2 out of 3 out of 10. But as soon as you can do this, it becomes a 9 out of 10 or a 12 out of, I mean, it just completely blows the value proposition through the roof, because you have an opportunity to buy investment real estate. It doesn't matter if it's equal or greater value, doesn't matter if any debt replacement at any time when the market makes sense the next day, and you become an owner of an LLC, and that's the first step. So step one is you're going to own or start a brand new LLC, okay? So I'm going to actually probably create this right here, a Google Doc, and so we can take notes appropriately here. Let me just open this and go new Google Doc. Okay. So step one, I guess you say step one is find the property, right? So find the property, underwrite the property, and that you want to buy. Just gather the deal and the returns, right? And then step two, you say, oh my gosh, this is the deal. I've gathered the returns. I like it. It's great. Is you form a new LLC, okay? And the new LLCs typically, and this one's is going to be in the state you're doing it, right? So the state of Texas for this particular one would be where the new LLC would be formed. And then step three would be to sign or update the operating agreement to a joint venture, JV partnership with the DST, okay? With the DST. In this scenario, we're going to put just for we'll put 2.5 million after closing costs, okay? With the commissions you're paying, should we sell the property and any other excess costs are about 1.5% to set up the DST in general. Okay, so you're updating the operating to a JV partnership. What's the partnership? Well, the partnership's going to be 80% Warren and Catherine, okay, 20% DST. Now, what's the DST putting up? Well, the next day it could put up, it could put up 80%. Let's just use, to keep it simple though, we'll just say it's going to put up $1 million, okay? It's going to put up $1 million. So the other 1.5 million is going to be invested into, at this point, stocks, bonds, and mutual funds, right? So I'll just put securities, okay? And then Warren and Catherine, guess how much you're going to put up? The answer is 0, okay? So you are personally putting up 0. The trust is putting up the $1 million. And Warren and Catherine, you're getting 80% ownership, okay? Ownership of the LLC. To Warren and Catherine for 0. 20% ownership to the DST. Now, the DST is going to ask for something called an 8% pref. Okay, that's a preferred return. So income minus expenses minus any debt service, they're going to want 8% on their money. Does that mean it has to be making 8% cash on cash? No. It could be a 5% cash on cash. Okay. And it's going to accrue that other 3 at a future date, whether it be a refinance event or whether it be rents go way up or whether it be a sale. Okay. So it could be a 5 cap. It could be a 6 cap. It could be a 7, but it's asking for 8% pref. The other 1.5 million is sitting in securities, ideally earning about 8% net of recurring fees. And Jake Miller is our financial advisor extraordinaire. He would come up with a plan for that, and we would review that based upon your risk tolerance. And that would be the goal there. So now let's go into step 4, which is, offer on the property, right? And or line up financing. Line up financing with a lender. Let's get that fixed there. Any questions so far on that initial step? 1, 2, 3, and 4, Catherine or Warren? And give me a thumbs up. You're on mute, so I can't hear you. Okay, good. All right. So now we're actually going to the property itself. So if you were to buy the property, and I think the property value, if I'm not mistaken, is about let's call it $350,000 to keep it simple. Okay. We said we negotiate a good deal. So in this scenario, we could buy 350. We could buy about 3 of them, okay? Let's say we negotiate. We'll say, hey, we'll buy 3 right now for $1 million. So we will do it for 3 divide for $333,000. So we'll go 3. Oops. We'll go E27. Where did that go? That one is at the purchase price. That's at E27. E27. Where is E27? Let's just do 354. We'll keep it 354. So let's say we took out like $1.1 million or whatever, okay? So the down payment's $88,000. You could do that, or you could just buy it all cash, okay? And what you're looking at is a total cash flow of about $7,000 in year 1, okay? And so what would happen? Well, if we times that by 3, because we said we bought 3 properties, we're going to take 7,728 by 3. It's about 23,184. So we're going to come back over here. We got 23,184, right? Notice that this includes the loan payment, the taxes, the insurance. It covers the management expense, the estimated maintenance cost, okay? And it includes what the income, we think the income is going to be. But we're taking this and we're timesing it by 3 because we're assuming we're buying 3 properties, okay? So this is 3 properties. Now, if we could get it for $1 million, okay? If we could get it for $1 million for these 3 properties, and I know it's a little bit off because of the because we're going a little bit higher. 354. Let me just do the actual number. 354,900. Actually, let's do 3 times. So $1,064,000. Okay, so $1,064,000. So instead of this, we're doing $1,000,064. Okay, so we got to ask ourselves, well, what's an 8% pref on $1,064,000? So $1,064,000 at 8% equals 85,176. Okay. So 85,176. So you say, well, there's $23,000 is all that's producing in the given year, right? So we're short 23,184. So we're at $61,000. That's going to be accruing. So I don't want you to think of it as short. I want you to think of it as accruing. So this amount is accruing per year. And the rest of it, this $23,000, is going to pay the trust, going to pay the DST, okay, which then turn around and pays you. Okay, notice this 8% is typically how we also structure our notes. So I guess you could even say pre-close DST is structured typically at 8% compounding interest over 10-year period of time. Because remember, you're becoming the lender. Okay, so since you're the lender, it owes you the money over a period of time. And that's on the full, for your scenario, let's say the $2.5 million. Okay, so $2.5 million at 8%. Let's do that math on that one. So 2.5, 8%, that's $200,000. Okay, so end of year one, the DST pays you on this one. Okay, $23,184. So it pays you that. It owes you $200,000. Okay, so there's an extra about what, about 200,000, 23,184, 176. That's accruing. Okay, any questions there so far? And you can unmute yourself too, so I can hear you.
Brett,
Yeah.
on the 2.5 at 8% equaling 200,000, weren't we using 1 million plus for the properties, which leaves us a balance of 1.5 in securities?
Yeah, so on the very top, this is on the total amount. So no matter how and where the funds are invested, no matter how and where funds are invested, if I'm understanding you correctly, whether that's in partnership with you on the Texas duplexes, or in securities, this amount is owed to you.
Okay.
Does that answer the question, or did I answer a different one?
No, you got it. You're looking at the whole DST. We were
Exactly.
just the LLC part.
Exactly. So the whole DST is the big amount of 2.5, and inside of the DST, we can do multiple investments. And so as a team, we're all trying to achieve, on average, about $200,000 of cash flow or accruing interest in any given year. Okay, so that can be in partnership with you to go buy investment real estate. That could be in securities. That could be passively into other real estate deals. That could be into some cryptocurrency. It could be into a number of different things. But the overall goal is to get that 8% on 2.5. And so we're just breaking down what's one way we could do that. Okay. All right.
So Brett, question here. If you have multiple like investments, or let's say you have another property that you were going to buy in, Tennessee, right?
Yeah.
So if that other property, can that other property's returns make up the deficit that this one right here would be making to get you to that 8%?
Absolutely.
Does that make sense?
So there could be a different amount of your risk tolerance could be different on different scales. So you could have a higher risk tolerance on some part of it with lower with higher returns, and a lower risk tolerance on the other side of it. And that's part of the beauty of the Deferred Sales Trust, is that we're diversifying the risk, and therefore we're diversifying the investments with the overall goal, not a promise, not a guarantee of the 8%, to go earn 8% net of recurring fees. Okay. Part of that's dollar cost averaging, right?
Right.
Go ahead.
So as long as all of the investments together equal 8%, it's good.
That's ideal, right? Now remember their original, even before, I'd say, tax tax flow versus cash flow, right? So their tax liability, remember, was $1 million. The government's charging them 0% on 1 million, as long as the funds are, let's say, in the DST and invested as below. Okay, it's at 0%. So for any, let's say, we like to see 8, but even if it's 5 or 6 or 7, like, it's better than 0. 1 million, once it goes, it's gone, right? It's gone. So the goal is to, typically we define a win as the 2.5 million is in today, and over the next 10 years, they've taken about 8%, and it's still there in 10 years. Okay, that 2.5 is still there, and then they do that again, they do that again, they do that again. Okay, it's not guaranteed, it's not promised. They can pass it to their kids. Their daughters can inherit this inside of their living trust and step into their shoes. But it's not a have to, right? And it's not a guarantee. There's risk involved in this. I mean, these properties could go to 0, right? They could not have cash flow. This is part of why the 1031 is not great, because typically people have to put all their money into one deal. And if that one deal goes south, Lubbock, Texas falls apart, right? Now you got nothing. Where in this scenario, we can diversify it. Does that make sense? Jake, anything to add on that?
I think the flexibility here is just wonderful, because not only can you roll something that's not necessarily like kind into something else, it allows you diversification amongst many different items. You don't have the time or the 45-day and the 6-month and all these different restrictions and limitations to find the next deal. And it gives you the option of what you want distributions from. So, I mean, perhaps you want to pay taxes on some of it. There's no arbitrary formula of what that number has to be. It can be whatever you need it to be. And you can pull that out and you can spend money on stuff that's personal, or leave it in and reinvest it and keep its tax deferred status going.
Excellent. I think it's also important to mention, right, this 85,000 here. How are we going to make that up, right? Because we got to have an exit plan. That's part of, as a trustee, I want to say, hey, Warren and Catherine, this looks like a pretty good deal. Like, some cash flow, it's decent. But remember, the trust owes you the 85,000 on this about 1.64 that we bought these 3 duplexes on, and we got a deficit of about 61,922 per year. So what happens? Well, potentially we could sell these things in the future, right? And let's say in 3 years, the price goes to instead of 364, it goes to 564. Okay. So that's an extra, say, $200,000 times 3, which equals $600,000. Okay. If our deficit per year was 61,992, right? I can just do times 3. That equals, what's that?
185,000.
61992, 3 times 185, about 185. 185,976. Okay. Right. And so then what happens here equals, we take this 600, we minus that. So there's an extra 414,024 left over. Okay. So what would have had to have happened? We'd had to have paid, and by the way, at this point, we've already paid back the original amount, which would be the 1.64. So the total property price at 564 times 3, because remember we bought 3 duplexes, 564, 3 times is $1,600,000, $1,692,000. Okay. We got to pay back the original 164. 64. Which leaves.
Mr. Becca.
Which leaves about 50,000, 40,000.
Yep.
1640123. Leaves $52,000. Okay.
Okay, I reached out to you guys.
Rebecca, you there? I think maybe put you on mute unless you have a question there. If you could, I'll ask you to mute there. She's talking to somebody. Okay, so here we are now. There's $52,000 after we paid back the original investment, right? After maybe it got to 564, and we've now paid back the trust. But remember, the DST owes you this money. Okay, it owes you the money. It owes you the 8% compounding. So you have partnered with the trust to purchase this property. You also received depreciation at 80% since you are an active general partner, okay? Of which you can offset cash flow from property and DST potentially, especially with what's called accelerated depreciation. Depreciation, okay? So that's another way to get some tax savings. Any questions on that for Warren and Catherine?
So, bottom line, what we were hoping is to find a piece of property or a couple of pieces of property.
Lean a little closer, Catherine. A little hard to hear you. Lean a little closer.
Bottom line is what we were hoping with a piece of property that we could invest in, that we could control, is to be able to pay the 8% back and still get a little bit money on the side in addition to, not necessarily looking at the bigger picture. We were hoping everything would be positive, the positive return. So I would like to pay myself back at 8%. I won't pay a bank 8%, but I'll pay myself back 8%.
Yeah.
Positive there. But if the property doesn't support that, then maybe that's not the way to go.
Yeah, maybe that's not the right deal. You're right. So there's a couple things to look at. There's cash flow and there's appreciation upside potential, right? And so when I think duplex, Texas, Lubbock, Texas, I'm thinking really good cash flow. I'm not necessarily thinking a lot of appreciation, right? There's a lot of land you can keep building. And so you would ask yourself, what's more important, my cash flow or my potential upside and appreciation versus the opportunity cost of other opportunities that are out there? And the time, energy, stress that it takes to own properties, unless you're moving to Texas, right? These are all things you have to balance. Now, the other side of that is, hey, I'm in control though. Like part of why I've always loved being a real estate owner and doing 1031 exchanges is because I'm owning my destiny, right? I could fly there and live in the duplex if I needed to, if everything hit the fan in California, right? Like I could do a lot of different things there. I can take over property management. I could lower the expense there if I was the handyman. So those are two things you have to kind of balance. Jakes, any thoughts on that thought there?
You know, I think something that you're illustrating is the fact that, hey, should there be income coming out that's taxable, this 8% interest, what have you, that you have to pay taxes on this little piece? Well, there's ways to plan and mitigate that. One of those you illustrated very well through depreciation. I think, though, that, you know, in addition to that, being a real estate landowner, there's the Augusta rule, and there's several other strategies that are proven and tested that can also help you in that scenario as well. And so just because, you know, we solved the problem of today, which is this really big transaction of some big sell, doesn't mean that we can't also help you. And this is part of what Brett and I do ongoing, is that we assist you moving forward, making wise tax decisions, wise investment decisions, and we help you manage your trust.
And it looks like Nico has a hand raised. So Nico, you have a question there? You want to unmute yourself?
So this is super time emails back and forth.
Nico, you're kind of breaking up. You might be in a tough spot. Do you maybe want to get in a little better location? It looks like you're
hold on. Yep.
Yeah.
Let me
come back in about maybe a minute if you're in a better spot. Okay. Warren and Kat. So we want to keep going on this, and then we'll get Nico back in when she's ready.
So, hey, here's a quick question, just some context. Is this a deal you guys are writing right now to see if it's worth investing, or is this already something you've purchased?
Yeah, Warren's already purchased a property, and we're selling and Warren and Kat have already purchased the property, and then Warren and Kat are selling their multifamily property in Sacramento, and going to be moving the funds into the DST. So we're pre-planning for where the funds could be invested. Nico, you ready again? Are you in a bed spot? You want to try it again?
I am. I switched Wi-Fi.
There it is.
Okay. So I was just saying this is super timely because I think I was asking you these very same questions in my emails the other day. So I had a couple follow-on questions. So looking at the figures that you were presenting, I'm looking at doing kind of the same thing, but with multifamily syndications.
Mm-hmm.
And my questions were kind of, how is the additional money made factored in? So say, for instance, you have an 80-20 ownership split, and with a multifamily, you do a refi event or a disposition. So they sell the 200 units and you get your money back, which hopefully is substantially more.
All right.
Is that the money that you get back, is that also split 80-20? Or are you saying because the DST has an 8% pref, they get their 8% and the rest comes to you?
Yes, to the extent that the ownership structure is 80-20, right? And you didn't purchase what's called an option. So let's walk through that scenario right now, okay? So what we first set up here was it sold for $564, okay? And that basically hit about 8% after the 3 years. But let's just go ahead and copy this. I'm going to paste it down here, and I'm just going to double that price, okay? I'm going to say, all of Southern California moves to Lubbock, Texas. And these duplexes, Warren and Kat, you found a gold mine. It's like an oil rush or a gold rush, right? And they're all rushing over there. And this thing goes to $1.5 million, okay, per duplex. It's like Manhattan Beach hit Lubbock, Texas, right? It's like, oh my gosh, I bought it for $250 and it's worth like $1.2 million, and we're just like jumping over the fence to get over there. Okay, so $1.5 million. Right? And we're like times 3, that's $4.5 million. Like, oh my gosh, this is like buying Bitcoin. So here we go. Remember, we had to pay back. So 4.5 million, and we had to pay back. Remember what was accumulating was that $600,000, right? That was the 8% pref, right? This equals the 8% pref to the DST. Okay, so we take 4.5 million minus $600,000. What did I have the 61.9 for there? I don't know yet, but let me just do this. 600,000. So that's $3.9 million left over. Okay, 3.9 million. Oh yeah, we had to pay back the original, which was about $1 million minus the original investment, which was $1 million. Was it $1.64 million? $1.64 million? That's what it was. $1,640,000. That seemed, was it $1.064 million or $1 million? It was 360. Hold on. I think it might be higher on that, right? No, it was actually 354,900 times by 3. It's $1,064,000, not $1,064,000. Oh, okay, this is $1,064,000. Sorry about that. So that actually might be better in our favor on the other one. Okay, so $1,064,000. We got 3.9 million. That gives us 2.85 million left over. 2,835,300. Okay, and then we now have to split that 80-20, right? 80-20. 80%, unless you bought an option, Nico, which you could, but 80% of that, which is left over, would go to Warren and Kat personally. So 2,268,240, of which you can roll or assign to the same DST for note number 2. Okay. 20% goes to DST. So the 20% of that, 2,835,300, boom, boom. is 567 060 goes to the DST unless option was purchased up front to carve out 98% of the upside, which would then pay out 2835 times 98%, which is 2.594, and then the other 2% would go to the trust. Now, when you think here, I don't want you to think like, well, then are we just paying the trust? Like we're losing that money? Like are we losing this 567? Well, remember our original thing up here. Our original thing was we got to earn $200,000 a year, right? So in this deal, we actually completely out-earned it. We blew it all out, right? But not only that, we got to earn that for 10 years. At $200,000 equals $2 million. So guess where this amount goes? Well, it goes in the bank to pay back, right? So you're not losing this 567 just because the deal ended. This 567 goes there to pay back you. Okay, I'm going to pause there. I know I said a whole lot. First, I'm going to start with Warren and Kat. How are you doing?
Good. So it sounds like you're basing a lot of this off appreciation and not cash flow. Is that correct?
The answer is yes, and it's both, and in both, right? So we're always looking at appreciation and cash flow, just like you would if you weren't using the Deferred Sales Trust. The biggest difference, though, is you have an extra $1 million at 0%. So we can be even more conservative in our approach, right? Because you have an extra $1 million. Or you could, some people say, I'm going to be more aggressive in my approach because I got an extra $1 million, right? So the answer is the fundamentals of investing remain the same. The difference is we have an extra 30 to 50% to work with from your gain.
Right.
Yeah.
So back to that original duplex. If you took the example of one duplex or three duplexes, either way, basically what I calculate on the cash flow is 11% return if you're putting down a 20% down payment on the first year. But yet, somehow 11%, which is more than 8%, was not sufficient to pay back the DST.
Can I jump in here? I have a question that I think, because I'm tracking with you on that as well.
Okay.
Brett, the 85,000 that you have over here, that's an annual return, right? That's an annual
screen of mine. I'm over here.
So yeah, because you have 1.064 million, right? And at an 8% pref, that brings you to 85,000. But that's an annual return, right?
Yeah, and I actually messed this up, guys. Just so you know, hold on. I did 164 instead of 1,064,000, right? So give me a second. Let me update that. 1,064,000. This will help us out here. Oh wait, no, it is right. A million. Did I do it right? 10. No, that's right. I'm sorry. I am right.
That's correct. Yeah. The 23,000 is that per duplex, or is that for all the duplexes combined? Because I think in this example we have 3 duplexes, right?
Yeah. So I think I answered both of your questions right now. So Warren, Kat, and Pierce. So what's happening is it's a difference between a down payment and leveraging at a 3% interest rate, right, versus a buying it all cash, right? So let's do a little quick little reminder of what a cap rate is, right? A cap rate is your unleveraged rate of return. Your unleveraged rate of return. So whatever you buy all cash, if your cap rate's a 5% cap rate, it's 5% cash on cash. If it's an 8% cap rate, it's an 8% cash on cash. Now, how do you get that 11%, Warren, right? Well, you borrow at 3 and you leverage it up, right? So you can typically bump your cash on cash from 2 or 3%. And so the question to ask any investment that you're particularly buying is, what's my cash on cash, right? And should I be leveraging this versus buying it all cash, right? And that's what so our assumption here, and by the way, could you put a down payment with the trust? You could. And could you leverage? You could, right? As long as your credit's good and the deal looks good. We have banks that will do the deal, right? So that would be the difference there, Warren. Does that make sense on the 8 versus 11? Okay. Yep. So, so back to where, Pierce, did I answer your questions? Or are you good there?
Well, I'm trying to figure out the 23,184. Is that for one duplex or is that for all 3 duplexes?
That was all 3. So if you look at this 7,728 was the cash flow here in year 1 on one duplex. So we times that by 3, and that gave us the 23,184. Now this has got to pay the DST, which has got to pay you, because remember the DST owes you the 8 anyways, right? It owes you the 200,000.
Right.
Okay.
Yeah, but Brett, I think the 23,000 is if you if you had a loan. That's the bottom line after an 80% loan, 20% down payment. And
that's a good point. Yeah, that's a good catch, Kat. Yeah, I'm sorry. There it is. Oh, here we go. $22,740. Look at that. We just found an extra $14,000. So here we go.
Yeah, okay.
So yeah, it did look a little light. I'm like, Warren, you're buying a 2 cap. What's going on?
Yeah, that's what I was trying to figure out. I was like, this deal does not make sense.
Sorry about that, guys. And so let's now do that. But at least we got the math there. So now let's do the math. So 22,740 times 3. So 22,740 3 times is 68,220. See, this is why we're all doing this together, right? We're in a class. We're all looking out for each other, right? It's going to pay the DST, which is going to pay you. It owes you the 200, and then but after the 68,220, you have remember you had 61,992 building up. So yeah, we're actually above. So we're above. We've got an extra 7,000. Just call it 7,000 to be simple here. Okay.
So what's the income for the 3 units or 3 buildings per year?
Kat, can you speak closer and then directly right into the microphone?
I was just asking what the income was of the 3 units per year when you take out the loan payment.
What is the income for the duplex?
Yes, all 3.
Well, 22,740 is on is 1 times 3. If you look at the screen here, times 3 equals 68,220.
Okay.
All 3 NOI, not including debt service, since debt service is 0, or just buying all cash. Okay. So what I did here, Kat, and you can go back and watch this, is on this year 1, I took the loan payment to 0 because there's no debt. I'm assuming we bought this thing all cash. Okay, so that bumped up the NOI, all right, to 22,740. I times that by 3 to get 68,220. Now, what's been accruing, remember, is that what's been accruing at an 8% pref is 85,120. So we've got, okay, remember 85,120 is building up. So that leaves minus the 68,000. So 68,220. So the difference is about $17,000. That would accrue. So 17,000 would accrue at that point. Would build up. Does that make sense there? Okay, we got thumbs up. Good. Pierce?
So what that means is this deal is probably more like a 7% return instead of an 8% return.
Yeah, that's a good way to think about it. Yeah, what was the cap rate, right? Versus cash on cash return versus cap rate versus IRR versus if you're going to leverage it, right? So this is why you have these different metrics, right? So, but yeah, I would say it's around a 7 or 8, and then you bank on some appreciation, but you get the depreciation by buying it yourself. So Nico, Rebecca, Clint, any questions on that? I'm going to open it up for you guys too.
No, but I think you were answering my next question was, could you roll over proceeds back into the DST so you don't have to pay taxes on those? And it sounds like you could without creating a new trust. You just do a note within that trust.
You got it. And also too, by the way, this cash flow, remember the DST, it doesn't have to pay you right away, right? So Warren and Kat living in California, they may or may not want the income right away. And let's assume they didn't need or want the income. This amount of money, the $68,220, which is paying the trust back first, right? Well, it can just sit in the trust. So that means your overall adjusted gross income, Warren and Kat, is $68,220 less, which in California can be as high as 25, 30, 35%. Okay? So that's the second part of the ROI, which is deferring the income tax off a property that you own. And remember, you got 80% of the depreciation on this. Let's do a quick math on that. If you bought the properties for $1,064,000, right? If you do some what's called accelerated depreciation, typically I've seen you take $1,064,000, you take 80% of that is going to be the building value, because the rest of it is land, because 20% is land value. And then from that, you're going to get about 25% in year one. So quick math. $800,000 or so in building value. 25% of that with depreciation accelerated equals $200,000 of depreciation. Now, that's the total amount. You're 80% owner of the LLC, right? So you could depreciate. You could use that depreciation, 80% of that depreciation. So what's 80% of $200,000? That's $160,000. So Warren and Kat, what I would recommend, guess what amount I want to recommend you pull out in the year one if we pulled this off on the DST? What do you think I'd recommend? $160,000. Why?
Why?
See that? It's pretty cool, right? Now, had you done a 1031 exchange the Blockbuster way, your old depreciation schedule travels, which means zero depreciation. So do you see how we just added $160,000 of value to you? Does that make sense? This is the most powerful part of all of this right here. So everyone watching this, and I've got to jump. I'm so sorry. I'm totally late. So we're going to come back next week, everybody. I'm 4 minutes late for the meeting. Okay. Or actually, I want Jake Miller to finish this off. I'm going to jump out, by the way. I'm so glad everyone joined. Please invite someone next week. We're over time anyways. You can go to capitalgainstaxsolutions.com. Make sure you mention Jake's name, my name, Pierce's name. Jake, you want to also remind people where they can find you if they want to take action right now.
Absolutely. 1-800-773-1848, 1-800-773-1848, or go to alphamarktax.com. There's a schedule booking link right there. Alphamark, ALPHAMARK, tax.com.
Cool. See everyone next week. Okay. Bye now.